Hi everyone. Let's take a look at problem 10-2A, which deals with an asset cost allocation and straight line depreciation. In January 2008, Mitsu Company pays $2,600,000 for a tract of land with 2 buildings on it. It plans to demolish Building 1 and build a new store in its place. Building 2 will be a company office, and it's appraised at $644,000 with a useful life of 20 years and a $60,000 salvage value. A lighted parking lot near Building 1 has improvements, Land Improvements 1, valued at $420,000, that are expected to last another 12 years with no salvage value. Without the buildings and improvements, the tract of land is valued at $1,736,000. Mitsu also incurs the following additional costs, and those costs appear to the left of my mouse. So there's a cost to demolish Building 1, there's additional land grading costs, there's cost to construct a new building for Building 3, and there's some new land improvements for Land Improvements 2. Okay, so we're asked to prepare a table, this is on part 1 now, with the following headings: Land Building 2, Building 3, Land Improvements 1, and Land Improvements 2. And then we need to allocate the costs incurred by Mitsu to the appropriate columns and total each column. Okay, well, to do that we need to come up with some determination of value so that we can do an allocation of the purchase price. So I believe they give us some appraised values. There's the tract of land without the buildings improvements. The tract of land is valued at $1,736,000. So let's underline this. Actually, let's bold this so we know that's what this little schedule is. And we're going to put the unimproved value of the land at $1,736,000 in there. What else do we know? The appraisal value of Building 2 is $644,000. Let's put that one down. Okay, then there's Land Improvements 1, and it has a current value of $420,000. And I think that's all the information we have of the current situation without anything going forward. So if we buy that tract of land with the 2 buildings on it, we've got $1,736,000 value in land. Building 2 is $640,000 and $420,000. So let's sum that. Okay. And now, since we have that, let me also just put a double underline on there. We'll format that cell with, I think you go to, I always forget where it here is. You have to go to alignment, you have to go to font, and then double underline, double accounting. That'll work. I'll slide that up. You can see I hit the OK button. And I got a nice format there. Okay, so now if we know that that's 100%, I can take that value, divide it by itself in absolute terms, divided by D28, hit the F4 to lock it in absolute terms, turn it into a percentage, and I should be able to copy above and come up with values that equal 100%. And they do. 62, 23, and 15 will equal the 100%. So now we've come up with the percent of total. And again, I will format that, right-click here, format that cell, make the underline double accounting. Hit OK. It works. Okay, now that we have the percent of total based on the appraised value, we have to allocate that purchase price of $2,600,000, which you appear right here, to the assets we acquired. Okay, so the easiest way to do that is drop in the $2,600,000 right here. Okay, and then we need to multiply take the 62% times the 2,006,000, and I will hit the F4 key to lock that in absolute values, and then I can copy down, and sure enough we should be copying from the right amounts. Now we know this works if we add all of these up, the three cells I have highlighted, and it equals 2,600, and it does. Okay, so what that has done for us, it's given us the allocation of the purchase price. Now we can work on preparing that table to the left of my mouse with the following headings. So let's slide up the screen. And I've prepared some of those headings ahead of time. Let's just move it up here. And so this will be prepare a table with the following headings. This would be a cost allocation. I'm just going to call this cost allocation. We'll put a period on the bottom and bold it, underline it, so that we know what we're doing. And we're going to base it on the allocation of the purchase price table that we did above us. Alright, well now we know that we can allocate the purchase price using the values we came up with. The land value, the apportioned cost is $1,612,000 right from there. The building 2 comes from that cell right there, the 598. We don't have a building 3 that came with it, but we do have a land improvement, and that's the $390,000. Okay, so we've got that put together. Now we also could put a column off to the right and total it if we wanted to make sure we accounted for the 2.6, but I can quickly highlight that and know that it equals 2.6. Okay, so that's the purchase price. But then we do some other things to it, right? We have a cost of a demolition. Let me slide back up. The cost to demolish building 1 is a cost of something. And what we must understand is we don't need building 1, so that is a cost that gets allocated to the value of the land. So we would put in $328,400, right? We're getting the land ready for its intended use. So we would write down demolition. We've dropped in $328,000. Now, there's also land grading. Again, that's another cost of getting the land ready for its intended use. And so we would drop in $175,400 under the land column. Alright, what's our next cost? Our next cost is $2,202,000 to construct a new building on building 3. Alright, so let's drop in that in the correct column. Oh, and now my formatting's off, so let me just format that, and I'll carry that all the way down to all these cells. Okay. The $2,202,000 is the cost for a new building. I think it's building 3. So we have it in the building 3 column, but I'll write it down like that. Is there any other costs to consider? The cost of new land improvements, $164,000 is the only one left. So let's slide up and drop that in there. So now we've got land improvements near building 2. And we'll drop that in right here, $164,000. Okay, since we actually don't need that building 3 written there, we're just writing what the source of those costs were. Alright, once we have that information, we could draw an underline key. I'm going to enter zeros in these others, actually just zeros in the last line, just so that we can see that there's a line there. And then we can sum the total. The total would be from here to here. We can then format that like that cell. So I'll use my format painter. Once I have that, I can copy across. And what I then have is the dollar amounts that we need to put together with the journal entries. Okay, so let's slide up and work on the journal entries. So I think this entry took place on January 1st, 2008. So why don't I just assume, let me move this to the left, and we'll assume this is the debit column and this is the credit column. And we'll center those. And we'll say that on 11228 we had the following entry. And I'm just going to put the entry down here. We have to, oh, and they want us to record, I believe, all of this in one shot. Yeah, single entry to record all incurred costs, assuming they're paid in cash on January 1st, 2008. So on January 1st, 2008, we have the following entry. And we're going to need to record all of these various items. So let's record the land first, right? And the land is going to be a debit of, oh, here, let me underline these. The land will be a debit of 2115. Then we're going to record building 2, and we'll enter an account for it in the general ledger, and building 2 is going to be equal 598. Then we're going to enter building 3. Building 3 will be equal the 2,202,000, and then we're going to enter an account for land improvements 1 and one for land improvements 2. I'll just copy this in, enter it now. So there's land improvements 1. Here we put the debit to land improvements 2, and we record cash. We'll indent this because the credit is to cash, and the total amount we're going to spend is the total of all those columns, which was $5,469,800. That should make sense because we paid $206 is our in these three accounts, and then we had some additional cost that we had to go out of pocket for. And of course we would then say to record cost of plant assets, and this would be what's considered a lump sum purchase. Okay, since we're assuming we incur all of this in one shot. Technically, though, the lump sum purchase really just involves the purchase price of the land building and the land improvement 1. Okay, the rest just happen to be other transactions that we're assuming took place on January 1st, 2008. I don't want to do that, but let me put that back. Okay, that takes care of the entry. Now, part 3, it says, using the straight line method, prepare the December 31st adjusting entries to record depreciation for the 12 months of 2008 when these assets were in use. Okay, so we know it occurred on January 1st when we purchased them, so now we need to record some entries on 12/31/2008. And these should be pretty straightforward. We know we need to record depreciation expense on building 2, right? And the dollar amount we would use would be equal to the cost. Do we have a salvage value? First, let's figure that out. Do we have salvage value? Yeah, building 2, 20-year. Oh, building 2 has a 20-year life. Oh, I'm sorry, land improvements has a 20-year life. Let's see, 60,000 salvage value, 20 years on building 2. Okay, so with that in mind, we know we need to take the cost of building 2 less the $60,000 of salvage value and divide it by 20 years. Okay, you guys all see how I come up with the depreciation amount? I'll hit the F2 so you can see it. Okay, so I take the value in cell D40, subtract the 60,000, put parentheses around that so that we get the numerator in total, then divide by 20. And that's our depreciation expense. Now I need to format again. We'll just format a whole bunch. So we get 26.9, and of course the credit then is going to be to accumulated depreciation, and I'm going to abbreviate here. on building 2. That's in the same amount. And we would say something like to record depreciation. Okay, now we then need to make the same kind of entry, so why don't I just highlight all of this, write this down, and we'll change the titles. And we need to record it on building 3, accumulated depreciation on building 3. Well, building 3 had a cost of, we have to do the same kind of format, of 2.2, but let's go find that accumulated depreciation before we come up with that. Where's our information? Building 2, 20-year useful life and no salvage value. Wait a second. On building 3, a 392,000 salvage value. See it above my mouse there? 25-year life. Okay, so we need to take the cost of building 3, put that in parens, minus that $392,000, close the paren and divide it by 25 years this time. Alright, so that's $72,400. There's our credit. We've got the second entry done. And the last one we've got a couple more actually. We've got one on, this would be depreciation expense on land improvements 1. Okay, and the land improvements 1 has no salvage value at all, and we had a cost of $390,000. So we simply take the $390,000 divided by its 20-year life. We come up with $19,500. And then finally, to record, I'll slide up again, the depreciation expense on land improvement 2. Again, there's no, with land improvements we have no salvage value in this case, and we incurred $164,000. So I'll take the $164,000 and divide it by the 20-year life. And we're through. Thanks, everyone.